If you tuned into last week's Silicon Valley Snapshot, this is a continuation of that part one. This is part two of Barry Habib's talk. It was a private conference for real estate agents. He's one of the most well-respected real estate and mortgage economists in the country. And he's breaking down for us in real time where he sees the market headed in 2023 and beyond. And it's just about to get good. All right, so I'm super excited to share part two with everyone. This is where it gets really good, and it really drives home where the market's going to be headed here over the next, 5 years plus. But before we get into that, if you're a home buyer in today's marketplace and you're looking for a comprehensive data set to help you in your decision making when it comes to buying a home here in the Bay Area, you can text the word data plus the zip code or the area or the neighborhood that you're looking in, and we will get that information sent straight to your inbox. And if you're a home seller in today's marketplace, you're trying to figure out, is now the right time for me to sell? Or if it's not, then when is the right time for me to sell? And when I do sell, what should I price my property for? All of those questions will be answered when you text the word data plus your property address to the number down below. All right, so here it is, a live reaction to part two of Barry Habib's talk at the Fast Forward conference in San Diego. I'm really excited. This is, it's getting good now.
Spewing this poison and yelling, there's a housing bubble, there's a housing bubble, there's a housing bubble. And here it illustrates to you what happens during recessions for home values. Here is 80 years worth of data, and you can see all the recessions, all these shaded areas of recessions. Home values up, 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 up during and after recession, 8 out of 9 times. Only one time it didn't, but here we have some special circumstances. The bubble came before the recession, not the recession causing the bubble. In fact, it was the recession that kind of started to help things level off. But what caused the housing bubble? What caused the housing bubble? It was simply too much supply of homes and not enough demand. So just like anything else, when there's too much of it and not enough people to buy it, prices go down. So how do we measure supply and demand? Supply of homes is measured by builders completing homes and putting them on the market. Not starting to build a home. It's not somebody selling their home because they got to buy another one. It is a builder completing a home and putting it on the market. That's home completions, which equals supply. Now, demand. How do you calculate demand? Demand is calculated by household formations. So how do we see what a household formation is? Here's a simple example. Imagine mom and dad and a child. They live in one household. At some point in time, that child grows and moves out and gets their own place. It's still the same family. It's still mom, dad, and a child, but they now have 2 households instead of 1. So they have formed a household. The next chart shows you in the blue lines for the last 20 years how many households were formed in the United States. And the gold bars show you how many homes were completed by builders. Now notice here in 2004 and 2005 was pretty close. There's another thing you should know. Because homes age and they have to be replaced over time, builders need to create about 100,000 more homes than there is demand because those homes need to be replaced. So you could see in 2004, it was pretty well balanced. 2005, pretty well balanced. But holy cow, what the heck happened in 2006? Builders went crazy. They built more homes than they ever had in history, 2 million homes. Look at today. We don't even come close to that. We're below 1.5 million since then. We've never even come close. But 1 second here, the demand fell off a cliff. Why did household formations drop so much? And this imbalance created more supply than demand and too much inventory. The next year, it got even worse because look how much more supply there was than demand. And by 2008, we had a full-blown housing bubble, ladies and gentlemen, and that was bad. It took a while for it to level off, but if you want to know why the housing market has been so strong, look at what happens here. Too much demand, not enough inventory, pushing prices higher. So now a lot of people, they say, oh, it's a housing bubble. It's going to be a housing bubble. Housing's going to crash. So many people putting that crap out there. Why? Go, because prices have gone up. Nope. Things don't crash because pricing has gone up. They crash because of imbalances in the system like this. So what we really need to ask is, can this happen again? Well, fortunately, we know how many homes builders are going to put up because you can't snap your fingers and a home appears. It takes a while to construct that home. But not only that, you have to go through the process of plans, approvals, permits. So you have good visibility over the next couple of years as to how much inventory is coming on the market. And we know That's about 1.4 million homes. Now, remember, there's going to be about 100,000 homes that get retired each year. So it's really about 1.3 million homes that should be hitting the market for new supply. But could we see a situation where demand falls off a cliff like this? That's scary, right? Well, what caused this? Let's think about it. The median age of a first-time home buyer is 33 years old. So what happened? Why were there so many fewer 33-year-olds in 2006 and 2007? Why did the number drop?
This is really interesting and just a different lens or a different perspective to be looking at supply and demand. Is typically we just think like, okay, well, jobs equals demand. I know that some of that is percolating right now, especially in the Bay Area, where we're like, oh my gosh, well, people are losing their jobs and so demand is going to go down. Well, this is a different lens, a different perspective to be looking at it. And it's something that you should absolutely be paying attention to right now.
In 2007, why did the number drop so much? Well, maybe it might help us to take a look at, did something change in the birth rates? Fortunately, I have a chart that shows you the birth rates. So if you were 33 years old in 2006, let's do the math. That means you were born in 1973. If you were born in 1973, when 2006 came around, you were 33 years old. So let's look at the birth rates from 1973. And as you can see, here's 1973. And here's the birth rates. Holy cow. It dropped off a cliff and then fell again, leveled off before going up. That sure looks a lot like what happened 33 years later, didn't it? Drop, levels off, goes up. Well, that's because if these people were born, they're going to be 33 years old 33 years later. So it should follow the same pattern. So why did this happen? Was there a reason, and can it happen again? Well, something did happen in 1973. Now, I'll give you the reason for it, but before we do, in today's day and age, a lot of people get awfully sensitive about things. So I want to just say as a disclaimer here, I have no opinion whatsoever. I am simply stating the statistical reason. So everybody, let's please just understand that. 1973, abortions were legalized. As a result of abortions were legalized, statistically, there were less births. And it followed suit into the next year. And then it leveled off and then started to go back up, which led to 33 years later, drop, level off and going up. So we know that that's not going to happen again. So what does the future hold? We know 1.3 million homes are going to be the net that we're going to get, but how about household formations? Household formations in 2023, 33 years old. You were born what year, everybody? You were born in 1990. Let's take a look at birth rates from 1990. Whoa. Big difference from 1973, isn't it? 74. You see, we're in a position where the demand is going to continue to outweigh the supply. Now, a lot of people are hibernating because we got awfully fast from three.
Now, notice how after 1990, it starts to level off and taper off a little bit and go down. But the point that I'm hearing Barry make is that we are still far above where we were in like that 65 to 73 range, where there were, 1965 to 1973, kind of in that time frame, were way higher births per year in the 1990 to 1998 range plus, really, for the entirety there after 1990. And so if the new construction or if the inventory stays roughly where it's at right now, then the demand is going to consistently outweigh the supply. At least that's what it appears to say. Like, that's what this chart appears to indicate. So pretty fascinating.
3% to 7%, and it caused some shocks in the mortgage market. As mortgage rates come down, and they will, recession, lower inflation, mortgage rates get more realistic, you're going to unleash a horde of buyers on the market. Now, let's really dispel this BS about housing bubble happening again. I want to explain to you by looking at this chart what a beautiful picture it points. So these are vacancy rates. They go all the way back to 1985. And notice for homeowners, the vacancy rate was pretty steady. And for rentals, also pretty steady until the housing market started to get very hot in the early 2000s. And what did people do? They started to buy homes to flip them. And as they started doing that, they weren't even renting them. They were just trying to buy them and flip them. And do you remember all the crazy mortgages? Do you know what the mortgage application was? Here's a mirror, fog it up. Let me take your pulse. You're approved, right? That was the no income, no asset, job, optional, down payment. Who needs a down payment, right? Credit score, lousy credit score, you're fine, right? So this was the type of environment we have. We clearly have nothing like that today. But as a result, people were just trying to buy homes who weren't qualified for them and flip them. You remember the movie The Big Short? They go to see the go-go dancer and she's shaking her stuff and she's going, I've got 5 homes and a condo, right? That was what you were looking at. People were just buying homes and trying to flip them. And you could see it here in the vacancy rates and rentals, and then even in the homeownership vacancy rates. People were saying that they're going to live there, but they didn't. And once the bubble hit, things started to level off. And today you see vacancy rates dropping in both homeownership and rental. People are buying homes today to really live in them. People buying homes today as an investment to really have renters there. People aren't looking to just game the system and flip them. These vacancy rates are not just low. They're at all-time lows. And if that weren't enough to dispel the BS about a housing bubble, you want to talk about a housing bubble. In 2007, there were 4 million units for sale in home inventory. Today, 980,000, less than a million. So we have 3 million less homes for sale, but hold.
And if you've been watching this channel for like a long period of time, even a short period of time over the last few months, you'll know that like inventory levels are ridiculously low right now in the Bay Area. And so these national statistics hold true locally as well. Just something to keep in mind.
Hold on a second. Our population since then has grown by 30 million. 30 million more people, 3 million fewer homes. How in the world can you talk about a bubble when you look at something like this? Now, hold on a second. I said 980,000 homes for sale. That doesn't even tell the real story, because of that, a very high percentage, because the housing market remains so hot, 40% are already under contract. You can't sell those. They're under contract. They're going to be closing soon. So how much is active listings? Only 578,000. In a country of nearly 340 million people, we've got 578,000 homes that are available for sale and active listings. How does that compare to historical? Less than half. This is more normal. We're less than half. I don't have to tell you. How's your inventory levels, everybody? Very low. So what happens when you can have a whole bunch of buyers? Now, how about all the crap about people saying, oh, what about foreclosures? Well, folks, today, the average home, 42% of the average home is a mortgage. 58% is equity. So the loan to value today.
That is staggering. That is a staggering statistic. To see the amount of equity that homeowners have built over the last 14 years is phenomenal.
42% of the average home is a mortgage. 58% is equity. So the loan to value today on average is 42%. In 2008, it was 81%. Only 19% equity in 2008. No wonder why people were handing in the keys back then. But today, you've got too much equity. It's not going to happen. Now, a big thing people talk about is affordability. If you're going to talk about affordability, you got to do the math. So let's do the math together. In 2021, the market's red hot. We all know that. So if you're going to buy a home with a $400,000 mortgage, back then the rate was 3 3/4 and your payment's $1,850 a month.
Now, obviously, there are very few homes for sale for $400,000 here in the Bay until you go out to the Central Valley. But these principles remain true, regardless of whether it's 400,000 or 4 million. So just pay attention. I know that like, you're probably thinking, oh, this doesn't really apply. No, it applies. It applies because it's math. It scales.
Okay. Now they compare it to today. Now, home values since 2021 to today have gone up about 6%. So that means you got to account for the fact that I'm going to need a 6% higher mortgage. So to buy a similar home, I got to take out a mortgage of $424,000. Okay. And the rate's gone up. Now rate's a little less than this, but let's just say 6 3/4. That means my monthly payment is $900 a month more than it was back in 2021. And this is where everybody gets crazy and they say it's not affordable. But you see, you have to dig a little deeper because we have good data on this. Fannie Mae shows us the average income that people were making in 2021 to buy this home with this payment. And as it turns out, think about 2 income earners earning about $50,000 a year, or the household income is about $9,000 a month. Now, we have good data from ADP, the payroll company. They measured 25 million payroll records, 25 million. And what they said is that incomes from last year to now have gone up 7.2%. That means these people are making $648 more. It doesn't cover it, but it's eating into it. But there is another problem. Inflation. Inflation for food, gas, and services. It's costing a family $250 a month more. And here's the problem. My payments are $1,150 more. My income's $648 more. So right now it's less affordable by $500 a month. And that's the facts. Okay. We can't argue with that, but hold on a second. This is a snapshot in time. The great Wayne Gretzky, he didn't skate to where the puck was. He skated to where the puck is going. You want to help your customers see the opportunity. Let's look at where the puck is going. Let's look at where the market's going. Now, incomes from 2021 to 2022 went up by 7.2%. So what are they going to go up this year? So if you go by ADP, they say 7.2. If you go by the Fed, the Atlanta Fed says 6.7. If you go by the Bureau of Labor Statistics, they say 5.4%. Let's be super conservative and let's say it's only 5%. 5% increase means I make another $473 a month. So that means while my payment's gone up $1,150, my income's gone up $1,130, which means I'm only $20 less affordable. By the summer of this year, I'll be $20 less affordable, and that's negligible, and make the market very similar in affordability to where it was in 2021. But hold on a second. Inflation's coming down. That means mortgage rates will come down. And what if we're right? And mortgage rates come down to 5.5% from their current 6.5%. And I believe they will, if not lower. Well, that means I'll reduce my payment further, and you can make a mathematical argument that it'll be $327 more affordable the summer of this year than it was in 2021. And I don't have to tell you what it was like in 2021. So what was our forecast? Lower inflation means lower rates.
Now, that's assuming that prices stay neutral between now, April, and this summer, which is like July, August timeframe. That's a really bold assumption, especially in the market right now. I am seeing in real time properties going 50 to 100 to sometimes 200, even $300,000 over asking price. Now, does that mean that it's going $300,000 over market value? No, because homes are being underpriced, but I'm not 100% sold that the affordability is going to be higher in the summer than it is right now. Meaning, yes, like I understand what he's saying, like, okay, by the summertime, if that holds true, then it'll be more affordable. But if we account for even more appreciation happening, then the affordability could actually be higher right now than it's going to be in 3 months from now. Again, that's speculation. There's no data behind that, but he makes an excellent point either way.
Recession-like slowdown means lower rates. I just showed you what the effective incomes increasing will do to affordability, and we have no affordability problem this summer. We know, you know, and I showed you the stats on tight inventory. And then what's your alternative? What, are you going to rent? How many of you look for rent for your clients? Is that a picnic? Can you not find anything? Are the rents super expensive? Are the rents rising? Of course. It is no picnic. You're paying somebody else's mortgage. So our forecast is for low single-digit appreciation for most of the country. We're not saying 20%. Let's just say 3%. Is that a bad thing? Well, let me show you. Look, everybody wants to time the market and say, I want the bottom of the market. Now, look, we feel really confident that after the market has gone up, housing went up 121 months in a row. That's 10 years and 1 month. Without a break, home values increased 1 month to the next. Think about that. That's amazing. All along the line, the media has been crying housing bubble, as I've showed you. But since July, home values have dropped a little bit. Now, it depends on what area you're in, what market you're in, but let's just say they dropped 2 or 3%.
Okay. Now, this is where it's not directly applicable, because we know here in the Bay Area, if you've been watching this channel for a while, there are some communities where we've seen a drop of 25% since April and May of last year to 12 months later, right now in April. So we have seen a dramatic drop in pricing, which speaks even more to the opportunity that's at hand right now, because it's like, when's the last time that the Bay Area had like a 15 to 25% discount tag on it? Like, it's been a long time since that has happened. So the opportunity at hand right now is rather large for those that are open to and willing to actually see it and acknowledge it.
Now, some places it might have been more. Look, if you're in San Francisco, San Diego, Los Angeles, Phoenix, Seattle, it might have dropped a little bit more than that, certainly because they've got a little over their skis in those markets. But we are very near a bottom. As soon as rates start to drop a little bit, you will see that bottom and you'll see prices come up. So when is the best time to do it? Well, obviously the best time would be at the bottom. The only thing is, I am not good enough to pick the exact date where there's a bottom. I'm just not that good. So I'm resigned to the fact I'm going to miss the bottom, and so should your customers. Your customer's going to miss it. So if they're going to miss the exact day that there's a bottom, Where are they going to miss it? Well, here's what most people do. They wait till there's a bottom, prices start going up, rates are lower, and they say, okay, now it's all clear. Here's where I'm going to jump in. Problem is that the seller's more confident. There's more competition and prices are already going up.
Okay. And if you've been watching this channel for a while, I've described this very concept with the bell curve and everything several times now on this channel with pretty much this exact explanation. So I don't know, Barry, if you've been watching my channel or whatnot, but yeah, I mean, like I could not agree more with this concept, which is if you are reactionary, which let's face it, the majority of people are. So if you're a reactionary, you are going to be buying in an environment where the seller is more confident, where there's more competition. Rather, if you wait until, or if you're on the decline, which actually I would argue that we are no longer on the decline. Okay. Here in the Bay Area. So we've already missed that mark. But the question is like, how far away are you going to be before you decide to jump in? Because before the bottom, the seller is less confident. There's way more opportunity. And that would have been like October of last year. Tons of opportunity in the marketplace, deals being made left and right, and not a lot of competition. That's the kind of environment that you want to be buying in for sure.
Going up. The smart time to do it is now. You want to get it before the bottom. Use the fear in the...
Yeah. And again, I don't know if I would agree with this necessarily because I don't think that we are pre-bottom at this point. I believe that we are already coming out. Unless it's one of these things where it's like boom, boom, boom up. So we could be in like a little bit of one of these, but like that's not what I'm seeing in the market right now at all. We are seeing homes appreciate over the last couple of months. Starting in about February of this year. If you've been watching the videos, if you're watching the snapshot, you'll know that in a lot of the counties, we've actually seen pending sales outpace supply for the last few months, or for at least in February. And then in March, SV Bank and that whole fallout happened. And so we started to see like a recalibration period. So, but right now we're back on an upswing and it's hard to know if there's going to be another downswing and then upswing or if like we're now out of the woods, so to speak. Time will tell.
Fear in the media, use the seller's fear, use less competition, a little bit better selection to jump in now.
Now what he's doing here, he's talking to buyers specifically. Yeah. So if you're a buyer, it's like, hey, like use the environment that we're in with all the uncertainty, whatnot, to create a better opportunity for yourself. Yeah.
And get the best price. You see, let me show you a case study. The last time we had a market bottom was in 2012. So around 11 years ago. Now notice prices were kind of coming down slowly, but then once they hit bottom, look how fast they went up. In fact,
it's kind of what's happening right now.
Home values in the year after the bottom went up 8%. 8%. But one second here. That's with inventory back in 2012 of 2.4 million. We've got 980,000 in inventory now. I can't even imagine the pressure that housing will come under once we reverse from the bottom with lower rates. I'm not saying 8%. I'm just saying 3%, okay, as a safe guess. So 3%, what would that do? Well, here's some math. If it was a $500,000 home with a $400,000 mortgage, now in the past month or so, rates have gone up about 1%. So people said, I'm going to wait because rates went up. No, rates going up is your friend. This is the opportunity you've been waiting for because the increase in rate cost you $250 a month and over a year, it's $3,000, but you'll refinance before that. So this might only cost you $1,000 or $1,500. But what did you gain? I can negotiate at least 2% now on a $500,000 home that saves me $10,000. And then if I'm right, we only go up 3%. Last time we went up 8% the next year. Okay. I'm only saying 3%. That's 15,000, which means I gained 25,000. And let's just say it cost me a little money to refinance because the rates dropped. So maybe between what I use up of the monthly payment and the refinance cost me $5,000. Why are you going to throw away a $20,000 opportunity? Because that's the difference if you wait, folks. The time to do it is now. Now, some people are going to say, hey, maybe I should rent, right? So should I rent? No, you should not rent. Even with a higher rate, renting is the wrong thing to do. $400,000 home, 10% down. Let's pick a rate of 6.5% and say they're going to live there for 9 years and never refinance. Well, what's the negatives about buying a home? Well, property taxes could go up. I don't have to worry about that if I'm renting. Repair costs go up. I have to figure $2,000 a year. I don't have to worry about that renting. And then the cost to sell, not at today's value, but the future value, which historically for the last 63 years, values across the country have gone up 4.75% per year. So let's factor that in. Now let's imagine on a $400,000 home where you normally pay $3,200 a month, let's say are getting a steal on the rent, $2,900 a month rent, and rents typically go up 5% a year, let's say only 4%. So we're making it really pretty to rent, really ugly to buy. So what's the difference? Well, it's $500 a month cheaper to rent initially, so I should rent, right? No. Look at the purple bar. Each year that rent goes up. By the 5th year, it's more expensive, and over the 9 years, it's a little more expensive to rent than own. But wait, there's more. Don't forget, a good portion of your monthly payment when you're having a mortgage payment is principal. People forget this. It's a forced savings plan. It's a huge difference in equity. It's actually cheaper to buy when you figure it's a forced savings plan. It comes out to, over the 9 years, $47,600, team. $47,000. Your customer is not told about this $47,000 benefit. And what about the 4.75%?
This is on a purchase price of $400,000. So if we do the math on, say, like a $1.2 million property, that number triples. So we're talking $150,000, give or take, on a $1.2 million home. It's a lot. It's a lot of money.
Average annual increase in appreciation. It's hard to calculate that. 4.75% on a $400,000 home, compounded annually for 9 years. It's tough for us to do it, certainly for a customer to do. That's why Albert Einstein said it's the 8th wonder of the world. We got to do it because it's $207,000 benefit. Now, that means the home's going to be worth $607 in 9 years. I got to pay 6% to sell it, but I do get a tax break. So what's the deal? It's better to buy the home than rent by $216,000. And by the way, if they refinance the thing to 5.5%, it's over $300,000 benefit, folks. Every year except year one, it's better to buy and rent. So Mr. and Mrs. Klein, if you think you're going to move in a year, rent, of course. But if you're going to be in this home 2 years.
I couldn't agree more. If this is a transitional situation, like, no, the costs of buying and selling and all that, it just it's not worth it. But if you were planning to stay in the area long term, then absolutely.
Or longer. Why in the world would you not buy this home? And why would you even think about renting? Well, I don't like a 6% rate. Well, do you like $250,000 profit? This is what you have to show them. And this is something you have to do.
All right. And that's the end of the talk. He went into a couple of other things that he was trying to, to sell the audience as most speakers do towards the end of their talks. But that was obviously a lot of information. And the key takeaway here is, look, there's always going to be there's always going to be reasons why you shouldn't. The market's going to crash, the recession, the this, the that. But if you just look at it from the most basic economic principles of supply and demand, there is a very strong argument here that the demand is going to far outpace supply for the foreseeable future. And even if jobs go away, some jobs go away as they are right now, and we're seeing like some jobs being lost. Well, 20% of jobs go away. 80% of the people are still employed. And by the way, when we're talking 5 to 10 offers on a property, that means like instead of 5 to 10, we're getting like 3 to 7. And not to mention with all of the money, all the stimulus money that's being pumped into the economy right now by the state of California with the Dream for All, which if you're not familiar with that, it's a down payment assistance program that's being offered by the state. So we are incentivizing, we're bringing new buyers into the marketplace. That is offsetting a lot of the collateral damage that could have been done by some of the layoffs that have been occurring over the last 12 months or so. Ultimately, I hope that this lends a fresh perspective to your decision making, whether you are a buyer or a seller. My hope is that this content gave you just a little bit more optimism when it comes to the long-term vitality of the Bay Area real estate market. If you've made it this far in the video and you're not yet subscribed, what are you waiting for? Click that subscribe button, click the little notification bell, and give us a thumbs up. It really helps us out, costs you nothing, and it helps us get in front of more Bay Area home buyers and sellers just like you. This is Danny Gould, everyone. I'm selling Silicon Valley, and I will catch all of you in the next video.